If you take 5 or 6 or 7 of these things and you pack them together, you can end up with a portfolio that just never has a drawdown. I've done this with a fair amount of money. They've outperformed Bitcoin, gold, stocks, bonds, silver for the last 5 years, but they've never had a drawdown year. The problem is most people do it wrong. What they do is they say, oh, I know that. That's basic diversification 101. So I'm going to buy Apple computers, and I'm going to buy, Pfizer, healthcare stock, and I'm going to buy McDonald's. That sounds diversified. But what happens is when the market crashes, they all crash together. People don't care that they're different verticals. They just care that their retirement's vaporizing. Yeah. So they just hit the sell button, they sell everything. What you need is something totally unrelated to that. Yeah. So I'll give you an example. It's actually exactly like an ETF. But the difference with an ETF is it can only trade it on that one exchange, the US stock market. Mm-hmm. When the market's closed, you're out of luck. And if somebody doesn't get authorized to trade on those, they can't get access to it. When it's tokenized, it's out of that system. It's actually in a global system that isn't controlled by any one government. The way that it is currently used in finance is it has to be driven by an experienced expert. This is a classic, what we call low data regime problem, and it happens a lot in it happens a lot in AI. People think, wow, these things are amazing in language. Yes, but do not expect that same sort of power on something like finance. If you have proprietary access to a pool of data, you can have models that are created that nobody else can recreate.
Hello, welcome everybody to another episode of Odys podcast. My name is Aneta Samkov, and today we're meeting at Consensus in Hong Kong. And my guest is Evan Szu, who is a co-founder and CEO of Gamma Prime. Thank you so much for coming, Evan.
Yeah, a pleasure. Thank you.
It's a pleasure to have you.
Yeah.
And I'm very excited for today's discussion about tokenized private investment. So you can tell us what's tokenized.
Sure. Yeah, tokenized is just a buzzword for taking something that is, like, say, what they call a real world asset. It could be real estate, it could be bonds, it could be gold, and then making it digital. That's all it pretty much is.
Awesome. Yeah. So you spent over 30 years as a market trader and have a PhD from Stanford, and were working on AI, machine learning long before it was really mainstream and popular. Yeah. So how has that background shaped the way you think about the markets today?
So I think the work that we do is really at that intersection of the tech and the trading. I would say the PhD is more just a training of how to think, think analytically. But I think the specialization that, that we have is essentially the use of technology like blockchain, like crypto, or like AI as well, and how that can benefit the world of finance and investment. So, yeah.
Awesome. So you have seen a lot of market cycles throughout the years, from traditional finance to crypto. What feels new about what's happening right now with tokenized assets?
Yeah, I think, well, specifically on tokenization, I think it's still quite early. So we haven't seen tokenization be the major mover in markets yet. But more broadly, I would say what sort of feels different around this cycle is there's been a lot of printing of money, right? There's been a lot of quantitative easing. That if you look at the total money supply, it's gone up substantially. And a lot of people in crypto are often very concerned about these things because, part of the original thesis of Bitcoin is you can't just print it.
Yes.
You can't just make more of it and that's why they sort of insultingly call the other stuff fiat, because you just make more if you want. And that's happened a lot in the last 10 years or so. So one of the things you see this in asset prices is that something like the stock market is like, it just won't go down because there's so many more dollars that have been printed that aren't actually being used in the economy. Where does it go? Well, it goes into assets. It goes into stocks. So you have this very inflated price I would say that is a major area that's new. It's changed the way I trade because I used to short the market all the time, and I don't do that anymore. So, yeah.
Good financial advice.
Well, yeah, I've been burned. I've been trying to short the market for like last 2 years.
Yeah.
It's been the one like horrendously, consistently losing trade that I've had. So I don't do that anymore. But I think it's because of money printing. I actually think that there's like a real shift there.
Wow.
Yeah.
Do you think that's permanent?
I unfortunately think that it is because, everyone's like, oh, the U.S. debt is going through the roof. I'm like, they're going to default. They're not going to default.
They're not going to default.
They're just going to inflate it away because they can always print money.
Yeah.
And it's they're the reserve currency. And there's no alternative. Everyone's like, oh, it's going to end as a reserve currency. That requires something for it to go to.
Mm-hmm. Yeah.
Right? It's not going to go to the Chinese yuan. As much as I think it's a great currency, it's just not convertible. It's not going to go to Bitcoin. It's just not liquid enough.
Yeah.
There's not enough gold to go around. So what's the replacement?
Yeah.
Probably nothing in the foreseeable future. BRICS is trying to work on their little currency. So I actually think money printing's here to stay.
Oh, wow.
Yeah, I think it's a bit sad.
Yeah.
But maybe good for Bitcoin. And you can see it's been good for gold.
Oh, yes, especially recently.
Well, I think it's a response to that.
Yeah, and real estate.
Yeah.
Yeah. Mm-hmm. So how has your TradFi experience influenced Gamma Prime's approach to tokenizing yields from hedge funds, private credit, or RWAs?
Yeah, I think having that traditional finance background has made us think of it as a piece of tech, but not the answer, right? Because we come from that world where we know tech doesn't solve the fundamental business problem, right? So the analogy I always give people that aren't in the world of crypto and Web3 is think of it like the .com website boom, right? There was this moment where everyone was like, websites, that's the answer. So if we have our crappy business and we just create a website, it'll fix everything. No, it doesn't, right? You still have the same crappy business, right? Tokenization is exactly the same way. Just because you slap tokenization on let's say a hedge fund, doesn't solve the problem of how do you get this hedge fund into a wider public, right? So I would say the thing that's informed the way we approach Gamma Prime is tokenization is just kind of like one little piece of the puzzle, but we actually focus on what we say is the problem is distribution. Okay. It's always getting it in front of people. It's always that outreach. It's the human factor. That's why we have large events. So for those that do the crypto conference circuit, Token 2049 is the biggest like crypto event, every twice a year. We are the biggest side event in all of Token 2049. We're in consensus, we're probably the biggest event. We don't know yet. Abu Dhabi Finance, we were the biggest event. We had 2,000 people show up live and 19,000 people streamed our event.
Wow.
People were like, are you an events company? It's like, no, because that's distribution, right? We are tokenizing the assets, but it's the distribution that makes it special.
Yes. So it sounds like tokenization is just a means to a goal, right? Yeah, exactly. So for listeners who don't really are that familiar with such alternative investments, can you speak a little bit about like uncorrelated strategies, what it is, and like how they can benefit from it? How can we explain it to the mainstream listeners?
Yeah. So
and why are they important?
People hear about this all the time. They're like, oh, you need diversified investments, right? And the reason why is if one's going up, the other one's maybe going down, and they sort of cancel each other out. So the idea is you have less volatility.
Yes.
The problem is most people do it wrong.
Okay.
What they do is they say, oh, I know that. That's basic diversification 101. So I'm going to buy Apple computers, and I'm going to buy, Pfizer, healthcare stock, and I'm going to buy, McDonald's, which is, fast food.
Yeah.
That sounds diversified because it's like different, sectors.
Yes.
But what happens is when the market crashes, they all crash together because when things are going into the crapper, people don't care that they're different verticals. They just care that their retirement's vaporizing.
Yeah.
So they just hit the sell button, they sell everything. So when people diversify, they think they're diversifying with something like stocks, they have a seatbelt that works great until they get into a car accident. It's until there's a market crash. And if you just want to look at this, you just look back during, Donald Trump decided to do the Liberation Day or Independence Day or whatever that thing is, where he started slapping tariffs on everything. Everything went down together, 20% in 2 or 3 weeks.
Wow.
What you need is something totally unrelated to that.
Yes.
So I'll give you an example. Reinsurance, right? That is essentially, it's Warren Buffett's favorite thing. It's insuring the insurance companies. That has risk, but the risk is too many hurricanes in Florida.
Yeah.
The risk is too many wildfires in California. The risk is not the stock market crashing.
Yeah.
You have litigation finance. The risk for that is an adverse ruling at the Supreme Court. Again, it's nothing to do with stock investing.
Yeah.
And this is the best reason to invest in crypto. It's not that there's something special about crypto. It's just that crypto is an uncorrelated asset. Now, Bitcoin is not uncorrelated. It has some tank with stuff, but you can do other ways of investing in I would call it the funding of the infrastructure. So staking, restaking, these are just technical terms. But the idea is there's things that you can do in it, and they are completely independent of the behavior of the stock market. If you take 5 or 6 or 7 of these things and you pack them together, you can end up with a portfolio that just never has a drawdown. So I've done this with, I manage a fair amount of money just for friends and family, not professionally. But meaning I don't charge a fee. But they've outperformed Bitcoin, gold, stocks, bonds, silver for the last 5 years, but they've never had a drawdown year.
Wow.
And the reason why is because I've diversified them into these very unusual kinds of investments. And this is the whole Gamma Prime story, is essentially people are like, yeah, but I want access to that. I don't know where to go to get that. So, we built a marketplace for it. So that's Gamma Prime, essentially.
So now regular people can use Gamma Prime for their investments?
It's still early. I would say that people can, they can get access to these things, but it's not fully online yet. It's not fully tokenized, not fully digital yet. But it will be. That's where we're going.
Oh, awesome. Very exciting. I'm looking forward to it. So in your opinion, what has been like the hardest mindset shift for traditional investors when you introduce them to tokenized versions of like familiar investment strategies?
Yeah, it's a great question. I think there's a misconception that tokenization means that it's like crypto, right?
Okay.
And so when somebody hears tokenization, sometimes they think, isn't that like dangerous? Like, isn't it like FTX, which is this protocol that blew up and it was in the news where there's like theft and so, isn't that like, Bitcoin's very volatile?
Yeah.
If tokenization is done right, all it is it's a digital representation of the actual asset. So I'll give you an example.
Yes.
Digital tokenized gold. All it is you have some amount of gold and it is in a secure place. It's in some sort of a vault. And the tokenized representation is a legal claim on that bar of gold. It's actually exactly like an ETF.
Exactly. That's how it says.
All it is. But the difference with an ETF is it can only trade it on that one exchange, the U.S. stock market. And when the market's closed, you're out of luck. And if somebody doesn't get authorized to trade on those because they're in some sanctioned country, they can't get access to it. When it's tokenized, it's out of that system. It's actually in a global system that isn't controlled by any one government. Right?
Yes.
That's part of the appeal. Same thing with Bitcoin, right? What's the appeal of Bitcoin? It's not controlled by the one government, right? That the exchange happens to be at. So that was the key difference. Besides that, just think of it like a stock or an ETF. It's a stock is the same thing. When you're trading it, it's a digital representation of company ownership.
Yes.
You have a claim on these shares within a company. And tokenization is the same thing.
So let's talk about the risk, because that's really a big question mark in many of people's heads who are not really into alternative investments, like the cryptocurrencies. They are perceived as risky.
Yeah.
How do the strategies involving tokenization and cryptocurrencies compare to investing in public markets and ETFs? Are they more risky or? Thank you.
Yeah, I think there's important to distinguish two kinds of risk, right? There's investment risk, which is things go up and down, you can lose money, right?
Yeah.
Like it can go wrong. And then there's, I would call it company risk, or sort of almost like fraud risk, right?
Yes, exactly.
And I think this is something you hear of a lot in crypto.
Yes.
Again, FTX, as I mentioned, was like this. Sam Altman-Friedman was like taking money that he was supposed to manage and using it to buy his mom a house. It was just like crazy fraud, right?
Yes.
There was, Anchor Protocol, which is a pure Ponzi scheme, right? Right. So, and let's be frank, right now in crypto, that has not been solved. That basic thing is known as intermingling funds, which is like, hey, I took money that doesn't belong to me. I'm your custodian. I'm supposed to invest on your behalf. It's supposed to be in a segregated account.
Yeah.
There's still not segregation in a lot of these crypto companies because there's no regulation on it, right? So what we prefer to work with is funds that are fully regulatory compliant.
Okay.
And what that means is they have an auditor, they have a fund administrator that will do things like segregate the portfolio. Like that's not your money. You can't just go and dip your fingers into there and go and spend it on a, party or a Lamborghini. You only get access to that if that's your rightful fee, right?
Yeah.
And that's what a fund administrator does. So I would say that once you're out of the realm of Wild West anything goes, and you're into the realm of regulatory compliant funds, you've not eliminated, but you've greatly reduced the company fraud level of risk.
Okay.
So what happens is institutions, family offices, people of greater wealth, the thing that they are doing is they're investing in these regulatory compliant products because that I would almost say it almost eliminates that kind of fraud company level risk. Then you're just left with investment risk, right?
Okay.
Within investment risk, alternatives span the spectrum. There's stuff that's much safer than stocks. We have some stuff that hasn't had a drawdown month in like 45 months. You know, you can't say that about stocks.
Yeah,
like stocks have had some pretty horrendous months.
Yes.
And we have some stuff that's way more volatile than stocks too, right?
Yeah.
And so what you end up in a situation there is that it's all spectrum, and then people can pick and choose. The nice part of alternative is that you can pick higher or lower.
Yes.
The problem with stocks, bonds, Bitcoin, treasuries is that they're all roughly in the same bucket in terms of risk. Yeah, treasuries are lower volatility and whatnot.
Yeah.
But treasuries have drawdowns too. And like I said, we have funds that have no drawdowns for many months in a row.
Wow.
So to answer your question is that it's actually, alternatives provide actually more choice. I wouldn't say that they're necessarily more or less risky by themselves.
Okay. But that's great for diversification.
Exactly.
Yeah.
Exactly. And I'll tell you, there's a lot of investors who would prefer something that's just like lower returns, but just incredibly safe. They just won't keep them up at night.
Yes.
Yeah.
Yes. Awesome. So what kind of outcomes are investors typically aiming for on the platform? Like stability, yield, diversification? We already talked about that, or maybe upside. What comes to your mind?
It's an interesting pattern that we've seen because the industry we're in is we're the hub, we're the gateway.
Yeah.
What we actually see is a spread depending on the net worth of the investor.
Oh, really? Very interesting.
If an investor is like, so everybody is accredited on our platform, which usually means, they have a few $100,000 at least to invest. Those people are often after like more aggressive returns.
Ah, okay.
But what happens is the further up you get on the like wealth curve, the more they're interested in safety until you get to like these sovereign wealth funds where it's not about returns at all.
Oh, wow.
It's all about drawdown is their backing, and like that sort of thing. So, and it sort of makes sense. You think about it, you're like, if I've already made a large amount of money, the main thing I just want to worry about is just not ending up in the poorhouse again.
Yeah, you want to keep it. You want to preserve it. Exactly.
Yeah, you don't want inflation to eat away, but like that's the only reason you're even investing it.
Yes.
Otherwise, you just leave it in cash.
Yes. Yes. You just don't want it to be eaten away.
Yeah.
But when you're the lower side, you're after.
We have more to gain, right?
Exactly.
And like the risk is asymmetrical because you're like, oh, well, look, I could lose a couple $100,000, but like that's not going to be fun. But that's something that's fixable. You lose a couple hundred million, that might be like something that you're like, okay, that might be impossible to get back, right? Yeah. Like, however I'd made it before might not be available to me again.
Exactly. So, yes. Very interesting. Yeah. You are the organizer, as you said, of the Tokenized Capital Summit series, and you ran them already in like quite a few locations. From the conversations that you have at these events, what feels like the biggest shift in how the institutions are approaching tokenized private markets right now? And what can we expect in the future?
I think they're opening more up to it. Originally, blockchain wanted to be completely what they call permissionless, which is like, it's all like anybody can do it. And like, there's no such thing as, say, checking if you're accredited or KYCing, making sure you're not a terrorist or whatever it is, right? It was supposed to be just the Wild West. Anyone can do everything they want, right? It was supposed to be totally transparent, meaning like you could see every transaction on the blockchain, right?
Wow.
That doesn't really work for an institution. I mean, if you're like, like a large hedge fund or a sovereign wealth fund, you don't want all your transactions out in the public for everyone to see.
Of course.
If you're a regulated entity, like taking, in the Cayman Islands, taking accredited investors, you can't take somebody that might be making their money from human trafficking. Like it breaks what they call AML, anti-money laundering, or KYC. And that could crash your whole fund because they can come in and be like, hey, you're running money through here that you don't know where it came from. Like that's maybe okay in the Wild West, but for a regulated fund, you're out of bounds and you could get shut down for that. But there's a good number of people in the community that say, look, there's something for everyone. Let's meet them halfway. Let's get some degree of permissioning. Let's get some aspects of privacy going, right? Let's get something that does allow KYC and AML, right? And that's been a shift that has also allowed these institutions to come and play.
Yes.
So I would say that is something that is happening more and more. And it's good for the ecosystem, in my opinion.
Yes, it opens up to a much larger audience.
Exactly. And everybody benefits.
Yes. Exactly.
Including the purists.
Yeah,
right?
Yeah, exactly. I know you have like a huge experience in AI and machine learning, dating back to like 1990s. So if you could tell us, what were some of the earliest neural network architectures or techniques that you worked with, and how do they compare to the like massive transformer-based neural networks powering like today's LLMs?
Yeah, my gosh, things have changed so much. I graduated from Brown University in 1995 with computer science degree, and neural networks was a part of that by sort of self-design. So I've been in this space probably 15, 20 years longer than most of the so-called experts.
Yes, exactly.
And it's not because I was some visionary. The reason is actually because my father, in 1987, was already doing AI and neural networks.
Wow.
He founded the International Neural Network Society, along with two other co-founders, in 1987. So the reason it was is because when I grew up, it was just the dinner table conversation,
Wow.
And I remember this was in the early 80s or mid 80s. my dad brought home a model that he had built on, I think it was like a pet computer or something like that. And he said, look, this model has figured out that the shortest distance between these 2 points is a straight line. And it was only like a 5x5 grid. And I remember, because my brother has also gone into AI, and we just looked at him and were like, why is that impressive? And he goes, I didn't train it to do that. It figured that out from the data and the testing. And I was like, I don't see what the big deal is.
Okay.
The crazy thing is, everything that we have now in machine learning is just an extension of those core principles at massive, massive scale. So it's massive scale of compute, but more than that, it's actually a massive scale of the data.
Yeah.
And the remarkable thing is when you just stack all of this data and compute onto the system, you get remarkable results. Like you can converse with the model in English, you know? And I would say that, or in many languages now.
Yeah.
I think the reason AI has become such a hot topic recently is mainly because the models got sophisticated enough that they brought the tech to average people because you can communicate with it in natural language. The tech itself has not really changed that much.
Oh, that's interesting.
The tech existed before, but the problem is the human had to come to the tech. The human had to understand how to do software programming and how to do optimization and blah, blah. Like that made it accessible to only a very small number of people.
Yes.
Engineers like myself, my brother's one of them, my dad. We don't see a kink in the curve. We see continuity from everything that's happened over the last 30 years. What we see is there's a kink in the public awareness of it because now non-technical people can get access to it.
Yes.
So I would say that is the dramatic shift that's happened. And it's more just because the model's gotten good enough that the model can now come to you.
Yes.
Yeah.
So actually, how have neural networks evolved like in their ability to handle financial like time series data, like market predictions or risk assessment? How are they used today?
So on that, there hasn't really been, I would say that fundamental of a shift because that, like I said, has been more of a straight line. Now, there are more people trying to do it because there's now this like public accessibility, people can do Claude code and stuff like that. But fundamentally, markets and machine learning are in a classic data shortage situation. Let me explain what I mean.
Yeah.
The reason these large language models, ChatGPT, Gemini, Claude, are so powerful is because they took the all this massive body of text, like that's been digitized, billions and billions and billions of, and they fed this into a model. And if you think about it, the English language, just in English, most languages, I would say, maybe only have 10,000 or so words that cover 99% of all language. And then the way those can be combined is pretty limited. Nouns, verbs, sentences, right? It's not like they can go in any order. So if you have billions and billions and billions of these examples, you can essentially map the entire space of language out. In finance, it's the other way around. Okay. There is never enough data that you could map out all the possible outcomes in finance.
Okay.
So I'll give you an example.
Yeah.
People are like, I'm going to predict stock prices. Yeah. Well, how much data is there? Well, there's maybe, say, daily data for the last 10 years. That's like, 250 trading days a year, so it's 2,500 data points. That's not enough to predict all the millions of possible financial circumstances and situations. Not even close. It's like orders of magnitude off. So people go, okay, well, then I'm going to dig in, I'm going to go down to minute level data. So that'll expand the amount of data. Well, that does, but every minute is not independent data. it depends a lot on what's happened recently, right?
Yes.
So you're not actually getting 300 and 3,600 times more data by going to minute level data.
Yeah.
But even if you were, that's still not enough it's not billions of data points. So finance has always been in a situation where it's highly, highly data constrained. And that hasn't changed. That's still the case, you know? So how it's used, well, I would say it's more in specialized particular niches, which we can talk about, but you can't, if anybody's tried it, you can't just go and ask ChatGPT to be like, go make me money.
Yeah. So there are still fundamental limitations in these models. Are there any other sort of limitations that we see with today's neural networks?
I would say the way that it is currently used in finance is it has to be driven by an experienced expert.
Okay.
This is a classic, what we call low data regime problem, and it happens a lot in it happens a lot in AI. So I'll give you, an example is, I built models for cancer detection for Roche's, one of their major assays, right? That's a classic low data problem because you don't have billions of examples of cancer biopsies. You have maybe a few hundred because there's not that many patients that you can get that sort of data for and staining for. How do you build a model on a few hundred examples? If you just are a dumb model builder, like you just don't understand machine learning, you just slam it into a model, it's not going to give you any usable results because it doesn't have enough examples to describe the space. So what you have to do is you have to do something known as hand engineering, which is you need to be an expert in understanding how to read these particular breast cancer biopsy stains. And you need to guide the model towards some key aspects that it needs to focus on. If you do that, then you can take the same data and make it go much further, right? And so in finance, the same thing happens, which is you need to have an expert in a particular style of trading, constrain the search space so that it's something that's very, very specific that the model can then work with. And what aspect do they constrain it depends on their style of trading. Because if you, trade a particular, let's say you do a StatR, mean reversion trading style, the thing that you need to know is very different than if you're doing a technical Forex trading style that's swing trades, right? So it becomes constrained by the expert. And that's true on almost all low data regimes. But it's not true on things like large language models because it just took all the stuff and just threw it all in there.
Okay,
so
I see.
People think, wow, these things are amazing on language. Yes, but do not expect that same sort of power on something like finance.
Yeah. So are you integrating AI in Gamma Prime? And if so, can you tell us a little bit about it?
Yeah, so we use it in several different areas. I think one of the interesting things is that we don't even advertise that we use AI because we view it as, frankly, table stakes. It's the minimum that every company should be doing is there's certain areas that it's useful. So, some obvious areas are, just analyzing customer behavior. Another area is as an intelligent advisor, right? So one of the big problems in the space is, registered investment advisors, they can't service everybody, right? But you can have a machine learning model that you train with some of that expertise and they can maybe take off some of that load, right? And then the last thing is, like I said, using it in actual trading. And that is very bespoke, meaning custom. It's just every particular trading style ends up using ML in a different way. And that's something that we do on a case-by-case basis with individual funds too.
Oh, very interesting. So do you think, because so many companies now pitch using AI, that it just became a buzzword, are there areas where when it's used, it's just overhyped? Because you gave us some positive examples.
Yeah, I got to tell you, maybe it's because I've been in this space for 30 some years, but I'm kind of a skeptic about it. I mean, I feel like because I'm in this private investment space, we see a lot of projects and stuff come through as well. So far, most of the time, the number one benefit that AI has for a project is that it makes it easier to pitch to VCs and maybe improves the valuation. I mean, look, for those that are interested in the AI space, the short answer I would give you is models mean nothing. Compute means nothing. The energy, all that stuff means that the only thing that is proprietary, that's an actual business moat, is data.
Oh, okay.
It's the only thing that you can actually protect. Everything else is going to be commoditized.
Oh, wow.
It's coming. Sure, NVIDIA chips are the best now. But look, if you use Apple, they have integrated memory, which, now you don't need your GPU memory can actually use your standard RAM. That's a huge advantage, right? There's Google has their, TPUs, their tensor processing units. Well, they've got certain advantages too. That's just the hardware side.
Yeah.
Models, it's open-ended. Not open-ended. A lot of them are open source.
Okay.
The competition is stiff.
Yes.
But data is something that you can't crack.
Yes.
If you have proprietary access to a pool of data, you can have models that are created that nobody else can recreate. And what I don't see a lot of is companies that are focusing on, hey, I've got this set of data cornered. And that set of data can be in a corner, a strange corner of the market. It could be, I understand how plumbers and electricians and tradesmen do their business. And I'm going to build a model specifically for them.
Wow.
Now that's a business. That's actually something that I would be well, that's interesting.
Yeah, that's proprietary.
That's something, and you're a tradesman.
Yeah.
So you know that industry extremely well. So you know what their pain points are, and you know how to use AI to address that.
Yeah.
Okay, that's actually more interesting to me than somebody coming along with the next, we're going to build the next ChatGPT for this. I'm already I'm having a skeptical response.
What do you think was the biggest breakthrough that helped to shift neural networks from niche academic tools to major forces in finance and beyond?
Yeah, I would say it's really that the models got good enough where they could bridge the gap to the layperson. Where essentially we went from you needing to be a computer programmer to the program being able to meet you at language, and the language is something that, everybody's pre-programmed with.
Yeah.
So suddenly everyone is a programmer, right?
Yes.
And this is the whole emergence of vibe coding. And I got to tell you, some people are I'm not sure if that's really real. I think it's hype. I'll tell you, as a software programmer myself and knowing other people in software programming, it is very much real. And it's really only happened in the last 3 to 6 months that these tools have gotten good enough that professional software developers, I know many of these guys, are I don't write code anymore. I'm an architect. And this tool writes portions for me. Now, I need to know how to scale it and deploy it and project management, stuff like that. But I don't code anymore. And that's a very recent phenomenon. If you think 6 months back, it's just June last year.
Yes.
That
Vacation.
This did not exist, right?
Yeah.
That is a revolution. And it is going to change the way businesses, it's going to empower businesses in a way that you can't even imagine right now. I'll give you an example. Many companies need to use something known as CRM, customer relationship management, right? Salesforce is the biggest one.
Yes.
There's this new term going around. They're there's going to be a SaaS apocalypse because with vibe coding, I've seen it done. You can create an in-house CRM that's custom to your specific needs in a not unreasonable amount of time with someone who's a reasonable software developer, a few weeks. And you never have to pay ongoing service fees. You never have to push buttons on a console and deal with customer service reps and blah, blah. You can, and it's not a generic piece of software for your business. This is like built for exactly your needs. And if you don't like it, you can modify it.
Exactly.
That is going to kill the SaaS industry.
Yeah.
And that's something that, like I said, only emerged really in the last 3 to 6 months.
And only if the people realize that, because I feel like many people are not yet aware that this is
It's actually a real thing.
a real thing and it's feasible.
I highly encourage people to go and try it. And look, is it going to be as good or as maintainable as something built by a software engineer expert? No, but maybe it doesn't have to be. You know?
Exactly. You have to weigh benefits.
Absolutely.
Yeah.
The cost versus paying $50,000 a year for a piece of SaaS software and having to call somebody up top every time there's a problem. Maybe you don't care about the scalability problem.
Exactly. So looking 3 to 5 years ahead, what role do you see AI playing in like the broader tokenized economy? I know it's like pretty far horizon to look after.
Oh, wow. I'm going to answer the question a bit sideways, which is in the history of massive technological transformation. I'll give an example, electricity, right? Everything's electrified. The jobs that were always the most affected were the blue collar, the kind of labor jobs, right? It was always the better machine to make labor easier. AI is one of the first major innovations that's really affecting the white collar.
Yes.
Because knowledge is very easy to digitize. And physical things like driving a truck are much more difficult. People there's often a new saying where it's just like, oh, when AI combines with robotics, then it will take over all the blue collar jobs too. Robotics is not in the same category as AI. Robotics is an engineering problem. It's physical. It requires AI is all digital. The whole thing is like happening with bits and bytes. And that is something that you can innovate and reconfigure and build on really, really quickly.
It's so much easier
than something like robotics. So, just look at how hard it's been to have like a home robot that can just do the dishes, right?
Or vacuum.
Right. Like it's something like it's a tricky affair. But AI has moved really, really quickly. And what's happening is it's hollowing out the middle of the job market, because if you are a business owner or like a software architect, you can do a lot more with a lot less. And I got to tell you, I fear for what this is going to do for the fabric of society if it happens too quickly. Because in order to have business leaders and to have these senior people, they need to be mentored up through the ranks. That's how they got there.
Exactly.
But if all the junior people are being replaced with AI, how are they going to get that experience? What jobs are they going to have? What's it going to do for, the fabric of society? It's an extremely vexing question. I got to tell you, it's something that I never thought I'd see the day that software engineers would be under threat in the way that they are now.
It's unimaginable a couple of years ago.
I thought, we'll have a digital economy, but there'll always be software programmers because you always need people to manage the digital systems.
Exactly.
Right? They will be the last ones to go. And I was so wrong. It's of course, because software programming is a very constrained language. If it can master the English language, it can master Python. The number of ways that the elements of Python go together is even much more restricted. So it totally makes sense that LLMs are going to kick butt on software programming. But it's everything. I got to tell you, legal work, so much easier digitally. If you want to plan a party, you don't need, it's just so many things that our white collar human beings were doing. And to have all of that transform all at once, I could see it happening in 3 to 5 years. That's cataclysmic.
It's very dangerous because even in the longer time horizon, like in 20 years, how will you get senior people if there are no juniors, right?
Yeah. The problem with 3 to 5 years is it's so fast that it may not leave time for people to adjust. You know, like you went through college and you got a computer science degree and you just graduated, you've got student loans to pay off and you're 2 years into your first job and suddenly all coding jobs vaporize that are in your tier. What do you do? Like, do you go back and learn a whole new trade?
Exactly.
Like, do you try to pick up vibe coding and make your own software? Like, what do you do with that? It's such a break.
Yes.
And if it happens in 3 to 5 years, I do think it will. I think it will happen that quickly, you know?
Wow. Very interesting. Thank you so much, Evan, for sharing so many of your insights.
It was a pleasure.
Wonderful. I think this is one of my favorite episodes for sure.
Well, thank you.
And thank you everyone for watching. If you enjoyed it as much as I did, follow Evan on LinkedIn, follow on Twitter, check out Gamma Prime, and don't forget to subscribe to our podcast for more episodes like that. Thank you.
Thank you.